So what can we say? By the end of this calendar year, maybe we can see bumper returns in the portfolio if this performance continues and if you have a portfolio that is aggressive in equity.
Yes, Kavita, that's quite likely. But markets are markets. They get so much information during a full year that they can behave differently as well. The game is all about probability. When you look at Nifty not having delivered any return for a year and a half, right? We are at similar levels like we were in October 2021, which is more little over a year and a half. So when the hope is the least, is when the probability of making the money is the highest. So that's what you see in April and May. The bounce backs are very, very steep. Like March ends, we had almost touched about 16,900 levels, and everybody was predicting a doomsday further fall. That's when sharp moves upwards come. That's point one. Point two, of course, from March, the foreign portfolio investors have gone very bullish on India and have added 63,000 crores as net purchase, $7.5 billion in a short span of about 2.5 months. Which is very heartening to see. The last full year, the market was buoyant on domestic flows, especially the institutions on the mutual fund and the insurance companies side. But I think this financial year has largely been led by the foreign investors, which is a very positive sign. When the globe is looking at recessions and slowdowns, the global portfolio investors being bullish on India is a reinforcement to the domestic opinions we may have.
All right. So now, how should one shape up their portfolio at this current juncture if someone is just starting out?
See, if somebody is starting out, then it's reasonably likely that he or she is young. So I think if you are young, then irrespective of where we are, 70-80% should be in equities. And there are quite a few other assets which creep into your portfolio without even making a sign, like a EPF or a PPF. All those are debt instruments. Whatever is the rest of the financial instruments, even if they are 100% equity for a youngster, it will not disappoint them. Of course, it will disappoint them during periods of short terms, but the long term is going to be far more fruitful. So point one, 80% at least for a long-term portfolio should be in equity, 20% should be in debt. So weighted average returns of this combination projected, of course, with a pinch of salt, if you take them 12.4%, the standard deviation, which is a risk measure, could be 10.7 on a combination like this. It's very important for the viewers to start acclimatizing themselves to hearing risks in numbers, is why we're putting that on your screen. Of course, it takes time to comprehend them, but at least a beginning somewhere. Medium term, 70% should be in equity, 30% should be in debt. Medium term, by which I imply 3 to 5 years, 11.6% could be the weighted average return. Looking at the contemporary situation, 3 years forward, 3 to 5 years, 9.6% becomes the standard deviation number on a 3-year rolling basis.
All right, but Feroz, one more question, on behalf of those people whose goals are actually maturing, or maybe they are just about to reach that particular stage when they need this money. Now, no one wants to really miss a rally like this, but how can they start planning their goal alignment in terms of just removing or coming out of the equity portfolio right now?
See, if your goals are just a year away, then you should stagger your exit out on 12 different installments. If your goals are a couple of years away, then you may not want to exit now because the valuations are reasonable. The earnings growth are phenomenal. Last year, if you remove one or two, like Axis Bank had a little write-off in terms of their acquisition. If you remove that, Nifty has earned about 840 rupees for the full financial year last year. And this year it's expected to earn 930 to 940 rupees is going to be the Nifty earnings. If my goals were 2 years out, I wouldn't be staggering an exit now. If it's 1 year out, I would take 12 different installments to move back to debt so that I don't have volatility on the last day when I actually want to access my money.
Is it time to go heavy in mid and small cap?
I think I would not use mid and small cap in the same breath because both of them have a very different characteristic, and at least at this stage there is a divergent opinion on both of these because historically it's always been them to be in the same statement. But I would say small cap I'm bullish, mid cap I'm further negative than even the large cap. Because mid cap now from a mutual fund investor standpoint implies the 100 to the 250th stock. Those 150 stocks are categorized as mid cap. And when you look at their future targeted stock prices, if you collate them, from credible sources. That's lesser than the Nifty's expectation. But on the small cap side, 4-5% alpha over Nifty, like I've been saying from our model portfolio itself, we've increased our small cap exposure from about 10, 12 to almost about 27, and we've reduced the mid cap exposure, keeping the large cap static. So to answer your point of question, Kavita, small cap reasonably bullish. If you can ride the wave, it can give you that 5-6% more than Nifty on a compounded basis over the next 3 years.
Would market be really expensive for someone who wants to enter or maybe start constructing their portfolio now?
Sorry, Kavita, I missed it. There's some little network
Yeah,
issue.
won't the market be expensive for someone who's constructing the portfolio now?
See, Kavita, no. If you look at expensive numerically, if you look at the historical forward earnings, now if 930 rupees is the expected earnings for this financial year, and Nifty is quoting at 18,600, let's assume, then we are speaking of 20 times current year earnings. Of course, we have just started the new year, so 20 times is not really expensive in terms of a PE ratio. Of course, PE ratios could be deceptive. If you look at other matrices, depending on the sector, I would not say that it's more expensive than the 10% of the long-term averages. So it's not too expensive, but of course, could you expect supernormal returns like the 20% IRRs over the next 3 years, which the last 3 years show? I would say no. But 11-12%, which are the median returns of Nifty, are quite par for course over the next 3-4 year holding period.
All right, one last question and then we move on to our viewer who's waiting online. What are the funds that you're recommending?
The funds I'm recommending from a different category standpoint, in the large cap category, continue to recommend the Franklin India Blue Chip Large and Mid Cap category, DSP Equity Opportunities, Mid Cap, Kotak Emerging, Flexi Cap, HDFC Flexi Cap, focused funds, ICICI Focused Fund, Multi Cap, Quant Multi Cap, Small Cap, HDFC Small Cap, Contra, SBI Contra, and Dividend Yield, ICICI Pru Dividend Yield Fund. These are category-wise, about 9 categories, which a person can actually include in their portfolio. Even if they have a 10,000 rupee SIP, it will be sensible to have all these 9 as well.